Benjamin Graham sat by his office window. The afternoon light drew soft amber lines across a table covered with years of books, scattered reminders of the battles waged not against others, but against the human mind itself. In the silence, he could almost hear the whispers of his students, the sharp questions of young analysts, the hopeful tone in the voices of those who still believed that only intelligence could overcome uncertainty. But Graham knew better now. He had seen intelligence destroyed by arrogance, logic distorted by greed, and reason silenced by enthusiasm. The greatest risk, he once told a young Warren Buffett, is not the uncertainty of the market. It is our inability to remain rational when everyone else is losing their minds. These words were not theory. They were a struggle for survival. Graham realized that every generation of investors began with the same delusion, the delusion that they could outthink the market. They read, they calculate, they model. But when the tide of excitement rises, even the most disciplined minds are swept along with it. He saw this happen in the euphoric 1920s, when fortunes were made overnight and lost even faster. And again in the 1950s, when a new generation of investors believed they had discovered a shortcut to wealth unnoticed by anyone before them. But there are no shortcuts, only cycles, cycles that repeat endlessly, taking on new guises but telling the same story. In every age, Graham wrote, the public is seized by the illusion of security at the very moment it doesn't exist. This delusion wasn't limited to the stock market. It was, in fact, a complete certainty that people found regulation in their money, that they believed it would be global, as it would be in the future, because doing so brought them relief. Yet the reality of the market was ruthless in its simplicity. It rewarded discipline and punished illusion. When Graham first began teaching, he viewed patience as a quality. Over time, he learned it was a skill acquired through pain, repetition, and humility. He would tell his students, patience is not passive. It's the most active form of discipline you can practice. Warren Buffett absorbed this lesson deeply. Years later, he would say, I'm 15% Fisher and 85% Graham. But those who truly understood him knew that Buffett's temperament, his ability to wait, to reflect, to detach, was pure Graham. For Graham, patience wasn't just about waiting for the right price. It was about waiting for the right clarity of mind. Because when emotions bias decisions, value disappears. And when everyone is chasing the same promise, opportunity hides in quiet corners where no one looks. The paradox of rationality is that it's often lonely. To think clearly means to stand apart. Being disciplined means resisting the crowd. And in the financial world, where identity, ego, and validation are built on flashing green and red numbers, standing apart feels almost like a betrayal. But Graham's philosophy made this very necessary. He required investors to build their foundations on principle, not speculation. An investment operation, he defined, is one that, after thorough analysis, promises safety of principle and a sufficient return. Anything beyond that, he said, is speculation. These words drew a line that many refused to cross. Because speculation was exciting. It was intoxicating. And in the short term, it often felt like victory. But as Graham repeatedly saw, every market boom carried within it the seed of its own destruction. The moment when faith turned to arrogance, when optimism turned to denial. A question for the future. Late one evening after a long lecture, a student asked Graham a question that haunted him for years. Professor, he said, if everyone learned your principles, wouldn't the market become perfectly efficient? Wouldn't value be destroyed? Graham smiled, that gentle, patient smile that always conveyed both kindness and irony. My dear boy, he replied, if everyone learned to think rationally, there would be no markets. Because markets are not built on logic, but on emotion, feeling, and compassion. My work doesn't end illusion. It teaches you how to deal with it. This was the paradox of his legacy. He didn't try to manipulate the market. He tried to manipulate himself, and he taught others to do the same. By the late 1950s, Graham had inspired a generation. Warren Buffett left Columbia to work with him briefly, and others have carried his philosophy to the present day. But what many didn't see, what history often forgets, was that Graham himself was still evolving. He began to question the rigidity of his own models. He realized that numbers alone could not reflect human irrationality, that even the most carefully analyzed stocks could defy logic, because people could defy logic. He once wrote in a letter, "The essence of investment management is risk management, not return management." This single sentence became the invisible backbone of modern investing, echoing decades later in risk models, behavioral finance, and the teachings of his intellectual descendants. Yet, in his later years, Graham's tone softened. He spoke less like a mathematician and more like a philosopher, because he saw that value, true value, was not just a calculation. This was an echo of character. Among Graham's many students was one whose story he never forgot. He was a brilliant young analyst, brilliant, driven, mathematically gifted, and gifted in many ways. He could recite balance sheets like poetry and spot inefficiencies faster than any machine. But he had a flaw. He wanted to get rich quick. When the market started to rise in the early 1950s, he stopped listening to Graham's warnings about speculation. "Professor, I understand your theories, but this time it's different," he said. "Every generation believes it, and every generation pays the same price." The young man leveraged himself by chasing momentum. He turned his analysis into justification. He found reasons to support the trades he already wanted to make. Within a year, his portfolio had tripled. Within 2 years, it had collapsed. When Graham saw him again, his face had changed, older, quieter, and more modest. "I should have listened," he said. "You did," Graham replied. "You just didn't believe yet. The market teaches belief through loss." It wasn't "I told you so." It was empathy. He was the empathy of a man who had made his own mistakes, lost his fortune in 1929, and rebuilt not only his fortune but also his philosophy from the rubble. Graham didn't judge him. He simply said, "Wealth built on understanding always returns. Lesson is more valuable than money." That quiet, almost invisible moment would later become the foundation of Buffett's temperament and Munger's fortitude. Because they understood it too, the price of wisdom is paid with humility. As time went on, Graham began to notice something interesting. Investment tools evolved. New rates, faster data, more advanced models, better systems. But the behavior of investors and business people remained the same. Every decade brought a new revolution. Radio companies in the 1920s, conglomerates in the 1950s, oil in the 1970s, dot-coms in the 1990s, and artificial intelligence and crypto in the 2020s. Different names, same psychology. Graham may have smiled at today's markets, not out of disapproval, but because he understood them so well. He knew that every next big thing would eventually collide with an ancient truth. Value lies in principles, not trends. Speculation, he once wrote, is most dangerous when it most resembles investment. This saying resonates today in every startup craze, every viral meme stock, every promise of effortless returns. Graham believed that the human mind had not evolved as rapidly as technology. This is why markets and systems remain as emotional as they were a century ago. By the mid-1960s, Graham's lectures had spread beyond finance. Philosophers, psychologists, and even military strategists quoted him. Originally a financial idea, the concept of margin of safety became a metaphor for life itself. It was said, always allow room for error in judgment, timing, and emotion. The margin of safety applies not only to your portfolio, but also to your soul. He often likened investing to characteristics. He said that numbers reveal behavior. If a company borrows money constantly, it reflects impatience. If it hides its debts, it reflects pride. And if it quietly continues compounding interest for decades, it reflects discipline and a systematic structure. He said the same applies to people. A man who increases his wisdom will eventually surpass one who merely increases his wealth. These weren't just words for the classroom. They were philosophies of life embraced by Munger, Buffett, and generations of others who saw that rational thought could be both a financial and moral compass. As Graham grew richer in his field, he began to move beyond the spotlight. He wasn't seeking fame or celebrity. He had long seen how public attention corrupts the mind, how people mistake popularity for proof. Instead, he turned to simplicity, a quiet home, books, magazines, letters and writings from former students, now leaders of their own empires. One letter was from Warren Buffett, written with the gratitude of a disciple who never forgot his teacher. "You changed my life," Buffett wrote. "You taught me that investing isn't about beating others. It's about overcoming your own impatience." This sentence deeply touched Graham. Then he realized his work had become something larger than himself, a chain of thought passed down through generations, constantly evolving but always anchored in rationality. In one of his final lectures, Graham stood before a house full of young analysts who had only seen prosperity. The markets were rising. The air was filled with optimism. He spoke in a naive voice, his voice slower now, but still sharp. "Markets will rise," he said, "and markets will fall. But the measure of the intelligent investor is not wealth, but philosophy. The storm doesn't define you. Your response to it does." He paused, looking at their eager faces. The house was brimming with ambition and youth. "When you leave here," he continued, "you'll forget half of what I said. You'll chase quick success, feel invincible, and lose everything once or twice. And when you return to these principles, you'll finally understand them. Because knowledge is remembered, wisdom is earned." As the lecture ended, a silence filled the house. The world outside had already changed. New markets, new instruments, new illusions. But the lesson remained, like a compass buried deep within every true investor. Years later, Buffett would recall that moment, calling Graham's philosophy the framework that makes everything make sense. And as the world moved toward an era of complexity and speculation, a new generation of investors would rediscover his message, not as an academic relic, but as a survival guide for the modern mind. When the lecture hall emptied, Graham sat alone for a moment, watching the dust shimmer in the afternoon light. He had spent his life studying numbers, but what fascinated him most was human nature. He once wrote, "Behind every balance sheet is a story, hope, ambition, and fear." And now, in the silence, he realized he had spent his entire career deciphering not markets, but the human condition itself. He saw that graphs and ratios were merely mirrors, the illusions of greed, caution, pride, and patience. Every rise is born of self-confidence. Every fall is born of forgetting what self-confidence truly means. He smiled. Because he finally understood, the market was never a teacher. It was a test. In the years that followed, the world changed faster than he had imagined. Computers entered the trading floor. Information moved at the speed of light. The game became faster, louder, and more ruthless. And yet its essence remained intact. Emotions still dominated logic. Fear still sold faster than facts. And every decade, a new generation rediscovered the same ancient lesson. The hardest part of investing, Graham once said, isn't finding the answers. It's dealing with your own impulses. His words eventually became dusty shelves. They became the key modern investors turn to wherever noise drowns out logic. Decades later, when Warren Buffett appeared before an audience in Omaha, he echoed his former mentor's words. In the short term, the market is a voting machine. In the long term, it's a weighing machine. Usually, everyone laughed softly, without realizing the depth of this line. But Buffett did, because he had lived through it. He had watched empires rise and fall, trends come and go, and yet the truth remained the same. Value doesn't disappear, attention does. And in this reality, Graham's ghost lived, quiet, rational, eternal. Today, his ideas resonate on a new battlefield, a battlefield filled with algorithms, AI models, and instant speculation. Investors no longer gather in crowded halls. They gather in digital media, driven not by discipline, but by dopamine. If Graham had been alive to see this, perhaps he wouldn't have been surprised. He would have simply said, "The tools have changed. The behaviors haven't." Because every screen still conceals a human heartbeat, still the longing for certainty, still the fear of loss, still the search for meaning in the noise. And perhaps that's why his philosophy has endured longer than any other trend. Because it doesn't just explain systems. It explains us. As the decades go by, Graham's name is mentioned less frequently than Buffett's or Munger's. But those who look deeper know the truth. He was the silent architect and mentor of their wisdom. He was the mentor who taught them that wealth without understanding is another form of poverty. His books gather dust on library shelves, but every serious investor carries them, if not in their hands, then in their practice. And that's the true measure of a teacher. It's not how loud he speaks, but how long his words linger after he's gone. Benjamin Graham's story isn't just about investing. It's about patience in a world obsessed with speed, discipline in a world addicted to noise, and reason in a world that rewards emotion. He proved that intelligence isn't genius, it's restraint. He proved that success isn't in anticipating the next move, but in preparing for the wrong one. And above all, he proved that wealth built on wisdom can never truly vanish. It grows silently, invisibly, exponentially across generations. As systems evolve and technology rewrites the rules, one principle still whispers beneath it all. The intelligent investor, Graham said, seeks understanding, not thrills. And in that understanding lies something far greater than profit, peace. The late 1940s were a strange time for Benjamin Graham. He was known on Wall Street as the man who cracked the code of investing, but deep down, he felt the system had broken him. Wherever he looked, speculation was back. The same reckless optimism that preceded the 1929 crash was rising again, this time with new faces, new jargon, and the same illusion. He would glance at the newspapers on his desk. Post-war stock boom. A new era of growth. And he would sigh, because Graham had seen this movie before. He knew how it ended. But this time, he wouldn't shout into the void. He would teach. Quietly. Continuously. Not with slogans, but with reason. And one of his students would change the world. Warren Buffett was 20 when he discovered the intelligent investor. He would later say, "I picked it up and it changed my life. I don't remember how much I paid, but it was the best investment I ever made." In those pages, Buffett found not only lessons in stock selection, but also a way of life. A discipline. A worldview that said, ignore the crowd. Look for value. Demand a margin of safety. And think like a business owner, not a gambler. For Buffett, Graham's ideas weren't just financial. They were moral. They were a rebellion against all that was wrong with the market: greed, self-deception. When Buffett first met Graham at Columbia University, the professor didn't seem like a Wall Street prophet. He had a naive voice, a touch of distraction, the calm demeanor of a man long since grappled with and reconciled with the chaos of the market. Yet, every word he spoke carried meaning. Graham's lectures were unlike anything the students had ever heard. He didn't shout. He didn't sell dreams. He simply exposed illusions. "You're not here to predict the market," he said. "You're here to protect yourself from it." The room would fall silent, because deep down, everyone knew he was right. Yet Graham wasn't teaching for popularity. He was teaching to prevent a generation from making the same mistakes they once made: chasing profits on paper, confusing speculation with insight. He knew most investors wouldn't listen, but maybe a few would. Maybe one of them would carry the torch forward. And so did Buffett. And later, Charlie Munger would join him, another mind shaped by Graham's quiet wisdom. They would take his principles and refine them, transforming Graham's defensive shield into an offensive philosophy. "Buy a great business at a fair price," Munger would say. "Not a great business at a great price." He didn't crave publicity. He preferred the quiet of his study, where the truth was clearer than the noise outside. But in that silence, he carried a heavy thought. Had he truly changed the system, or had he merely delayed its madness? He would open letters from former students, some filled with gratitude, others with confessions of failure. "Mr. Graham, I followed your rules, but the crowd always wins in the short run." He would write, "Yes, I did. But remember, in the short run, the crowd survives. In the long run, the wise endure." Years later, when journalists asked Warren Buffett who his greatest teacher was, he wouldn't hesitate. "It's Graham. Without him, I wouldn't exist." Buffett built his empire not on instinct or timing, but on Graham's logic. The irony? The teacher's name was forgotten, and the students became legends. But perhaps that's just how wisdom works. The greatest minds don't seek credit. They seek clarity. And Benjamin Graham's clarity continues to resonate in the portfolios, philosophies, and lives of those who still believe in smart investing. But the story doesn't end there. Because as the decades passed, a new paradox emerged. Graham's once radical teachings were now mainstream. They were quoted, copied, and misunderstood. Investors used his name to justify the behaviors he warned against. He had ignited a quiet revolution. And like all revolutions, this one was being rewritten by those who never understood it. The next morning, the market opened like a raging wave. Green waves turned red within seconds. The young analysts, once proud of their precise models and flashy algorithms, looked shaken. They had predicted the opposite. Benjamin Graham's words echoed like a chilling melody in the silence of the stock exchange hall. "You are not here to guess. You are here to understand." Understanding, a simple word, yet the rarest currency on Wall Street. For decades, investors have confused activity with intelligence. They measure their value by transactions, their wisdom by speed, their success by adrenaline. But Graham's teachings, passed down to Buffett, Munger, and anyone patient enough to listen, warned against this seductive trap. He used to say, "An investor's biggest problem, and even their biggest enemy, is probably themselves." Today, this truth rings true more acutely than ever. Because in an age of AI-generated predictions and social media investors shouting buy, sell, in 20-second clips, the illusion of mastery has reached its loudest pitch. Everyone feels like a genius until the tide goes out. When Warren Buffett first entered Graham's class at Columbia, he didn't resemble the future billionaire we knew. He was curious, almost too curious. And that's precisely what Graham admired most. He didn't teach him what to buy, he taught him how to think. Buffett once said, "I'm 15% Fisher and 85% Benjamin Graham." But one point he didn't always emphasize was this. The Graham percentage wasn't about formulas or ratios. It was about discipline. It was about remaining rational when everyone else was losing their minds. Every great investor who came after him, Munger, Templeton, Klarman, bears traces of the same philosophy. It wasn't a method. It was a mindset. If you browse financial channels or TikTok experts today, you'll see a new kind of frenzy. Everyone's selling certainty, the promise of instant clarity in an uncertain world. But the truth Graham told his students in 1934 remains unchanged. Achieving satisfactory investment results is easier than most people realize. Achieving superior results is harder than it seems. This paradox, easy yet difficult, defines everything about true investing. The point isn't to find the next big thing. The point is to learn from the next big mistake. Every investor encounters two voices deep within. The speculator, loud, impulsive, hungry for action. And the investor, quiet, patient, willing to wait for the long haul. The market rewards one for a moment, the other for a lifetime. In every crash, the speculator screams first. In every recovery, the investor smiles last. That's why Graham called the market a voting machine for the short term, a weighing machine for the long term. He didn't mean it metaphorically. He said it as survival advice. Because the market is designed to test your faith, to test whether your patience is real or merely an illusion. In 1972, toward the end of his life, Graham was asked in an interview, if you could give one piece of advice to young investors, what would it be? He smiled and said, be less influenced by others and more interested in the truth. He knew how fragile truth becomes when filtered through money. Every generation rediscovers this lesson the hard way. In the 2000s, there was the dot-com craze. In the 2020s, meme stocks, NFTs, and algorithmic trading. Different costumes, same game. While the crowd still cheers for shortcuts, Graham's ghost silently holds a mirror in the back of the room. Ironic, isn't it? The world has more data than ever and less wisdom than ever. People are after information, not understanding. They learn what's trending today, but not how it matters. They call it research, but it's really entertainment disguised as intelligence. That's why this story, Graham's story, is more important than ever. He wasn't just teaching you how to analyze stocks. He was teaching you how to analyze yourself. Because if you can't control your own impulses, no spreadsheet in the world can save you. And that brings us to this moment. To you, the listener. You might be sitting at your desk, watching financial videos, wondering how everyone else gets it. But here's the truth Benjamin Graham discovered long before any of us. You don't need to beat the market. You need to lean into it. The market runs on emotion. You have to walk with logic. The market lures you with action. You must find strength in stillness. That was the quiet revolution he started nearly a century ago. And today, it's still unfolding inside every investor who dares to think. But something had changed. The young analyst, the same one who once mocked Graham's outdated wisdom, sat quietly, staring at an old, faded quote taped to his screen. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. He'd read it dozens of times before. But tonight, for the first time, he understood. The votes, the noise, the trends, the hype never mattered. What mattered was weight. Reality. The moment the market stops rewarding arrogance, the illusion of mastery vanishes. It was in those moments, after a loss, after a silence, that Graham's voice was heard loudest. He never shouted. He never promised quick riches. He simply invited people to think. And in a world built on noise, Thinking became the rarest form of rebellion. That's why his disciples, Warren Buffett, Charlie Munger, Irving Kahn, all shared the same quiet demeanor. They weren't trying to impress anyone. They were trying to outsmart everyone. Buffett once said Graham gave him a map for a world that doesn't want to be mapped. That's the tragedy and the beauty. True investors don't seek control, they seek understanding. Imagine standing on a pier watching the ships pass. Some are fast. They chase the wind, burning fuel. Others move slowly, their loads heavy, steady against the waves. That's the difference between speculation and investment. One is speed, the other is direction. And while the crowd applauds the swiftest ship, the wise quietly fill their ships with value and let time become the wind. When Graham wrote Security Analysis in 1934, the world was rebuilding from destruction. The Great Depression had shattered confidence. Fortunes evaporated overnight. He had seen his colleagues lose everything, not through ignorance, but through illusion. They believed that knowledge guaranteed security, but it wasn't. Only discipline did. That's why The Intelligent Investor wasn't just a book. It was a shield against hysteria, against the ego that whispers, "You know better." Because every generation needs protection, not from others, but from himself. Years later, as Buffett reflected on his own journey, he said something few realized. It's not a lack of intelligence that kills investors, but a lack of emotional control. These lines could have been written by Graham himself. Because it's not ignorance that destroys wealth, but impatience. The market rewards those who learn to endure boredom, to wait in chaos, to do nothing when doing nothing is the hardest. And yet, the same delusion returns every cycle. This time is different. The same words that preceded every crash in history. You see, Graham's revolution was never loud. It didn't make headlines or trending videos. It was built to last. The power of compound interest, not just money, but wisdom. Every lesson, every mistake, builds upon the next. Not overnight, but over decades. And when you finally understand this, you stop playing the market. You start partnering with the market. If you listen carefully, you'll notice something timeless. Every great investor eventually stops talking about money and starts talking about temperament. Because when you master yourself, the market can't control you. That's why Buffett quotes Graham, even after all these years. Because truth is timeless. And patience, while it may sound old-fashioned, remains invincible. So the next time someone tells you they've cracked the code, remember what Graham taught his students with a half smile. You can't make money faster than your understanding. The illusion of mastery fades quickly. But the power of wisdom is forever compounded. As the analyst shut down his computer, he noticed something strange. The charts no longer looked like chaos. They resembled rhythm, like a song written by the hands of history. For the first time, he didn't feel like he was playing the market. He felt like he was listening to it. And in that quiet moment, the moment when understanding finally replaced the noise, Benjamin Graham's revolution continued. Not in books, not in the charts, but in minds brave enough to think differently. Next time, we'll delve deeper into the invisible skill that binds every successful investor together. The ability to wait. Not idleness, not laziness, but consciously. Because patience isn't passive. It's the ultimate strength. And as Graham once said, an investor's greatest asset isn't their intelligence, it's their character. If this story resonates with you, take a moment to reflect. The greatest investment you'll ever make is in your own understanding.